Okay, so I'm starting to get a bit better of an understanding of what this whole Wall Street Bets phenomenon is going to mean for the financial markets. There's an excellent article today in Zero Hedge that I'll try to link to, which they didn't write. They just compiled a Twitter thread from a user. Gosh, what were they called? It was something 248. I feel terrible. I forgot the guy's name. But this was a Twitter anon who was explaining the liquidity issues that Vlad, the CEO of Robinhood, was alluding to in his interview on CNBC, which really piqued my interest at the time because he made it pretty clear that the reason why he was saying, oh, no, we're not restricting trades on GameStop and all these other stocks because Citadel told us to. No, it's because we're out of money, which is a much worse, that's a much scarier thing that's a much bigger red flag. And so what this thread got into was detailing a little more how Robinhood's business works and how a Robinhood account works. It was very interesting to me because I wasn't aware that all these people on Robinhood pretty much have margin accounts, which works kind of like a bank account. I've explained this before, but for those of you who don't know, when you put money in the bank, it's not your money. You're lending that money to the bank, and what you own is a claim to money, from the bank. That's what the bank issues to you. You give them money, and they issue credit to you on your account. And so you exchange money for a claim to money that is redeemable on demand. And a Robinhood account works much the same way, whether you have cash or stocks in that account or ETFs or I don't think you can buy bonds through Robinhood. But crypto, whatever the asset is, you don't actually own it. It's just credit. The value of it is just credited to your account. And so if you, for example, bought one Bitcoin through Robinhood, you don't own one Bitcoin. Robinhood owns one Bitcoin, and they credit your account with the value of that Bitcoin in dollars. And so if you wanted to close out of your Robinhood account and say, I don't like using Robinhood anymore, I'm going to use Webull, or I'm just going to get my own broker on Wall Street who I can call up and have buy things for me, the old-fashioned way, like Bud Fox or Gordon Gekko, there's no way for you to take ownership of that Bitcoin, have it transferred onto a hard drive, or for you to take your shares of GameStop or your shares of SPY with you, because they're all owned by Robinhood. All Robinhood will do is just close out your account by giving you the cash value of those assets. Now, also, just like a commercial bank, a fractional reserve bank, Robinhood can loan out the assets that you have in your account that they're credited to. And this is an act of, fractional reserve banking. And this is how short selling is accomplished in the present-day market. Now, I have nothing against short selling in principle. I'm a big fan of it. I think the idea that there are certain investors who take a lot of risk by taking out a loan denominated in an actual asset that is not dollars, which must be repaid in that asset, who risk potentially infinite losses. I think that is a very admirable form of investing. I think that certain assets deserve to be shorted and should be when they're overvalued. But the way that things are done currently, and I did not fully understand this, short selling as of now is accomplished through what is basically fractional reserve banking, and that means that let's say you buy 50 shares of GameStop. Robinhood is not going to just buy those shares and hold onto them in an account for you. No, what they're going to do is they're going to loan out some of those shares to somebody who wants to short the stock. And so that creates two separate claims to the same shares. Those 50 shares you think are in your account and that you own them, but at the same time, those shares are being loaned out to, let's say, Melvin Capital, who just went and sold them to somebody else who now has ownership of those shares. And so then if you want to, let's say, sell your shares that you think you still own, Robinhood has to scramble and go out and buy back 50 shares of GameStop to sell for you on your behalf. Or more likely what they have to do, they wouldn't actually do that. They have to come up with the cash value of those shares of GameStop that they no longer have. And so now once I realized this, it suddenly made a lot more sense that, why Robinhood was having liquidity problems. Because I was thinking to myself, it's like, well, if Robinhood is just a broker who goes out there and buys assets on behalf of its clients, well, if Robinhood, is becoming the most downloaded app in the App Store, and you have all these people flocking to Robinhood to buy shares of GameStop, this should be, the greatest thing for their business in history, because they're having this huge influx of new users who are sending them money to go out and buy shares. But what ended up happening is that even though we don't know the exact details, with all this volatility, Robinhood ended up on the wrong side of this whole situation, and they were left with too little liquid cash to actually continue their normal operations. And so while everyone is focused on how Wall Street Bets almost bankrupted Melvin Capital, they almost bankrupted Robinhood. Robinhood has, only survived, it seems, because of a $1.5 billion injection in liquidity. And so given all that, I would be, again, this is not investment advice, but I would be very nervous about having my investments at Robinhood. If this, level of volatility, was able to destabilize them to that extent that they required, $1.5 billion in liquidity injections from their investors and from loans, that tells me that they're way too they're way too leveraged, and that there is in fact a price to using these brokerages that advertise that, oh, we charge 0 commissions. Well, it's not that they charge 0. It's not that these people are just working for free. That money that they don't make in commissions, they have to make it up somewhere. And apparently, the way they make it up is by, at least in part, is by loaning out your assets, and of course by selling by selling the right to Citadel for them to front run you. They sell essentially inside information to Citadel. Not that I'm accusing them of anything illegal, because again, I don't want to be sued by any of these people. Now, going back to a theme that I've been, hitting upon since I started this channel, our financial infrastructure is very fragile, and this is a good example of that. It's taken me, because I'm not someone who works on Wall Street and understands the ins and outs of the technical aspect of this so much, because again, I focus more on the macro stuff. But this week, what's almost happened to Robinhood, what might happen to them in the future, is an example of how little volatility these people can handle. Again, if you really want to see things get crazy, let's see the Fed raise interest rates by 25 basis points. There's way too much leverage in this system for things to move around that quickly, for prices to shoot up and down, like we've seen in the case of GameStop, without certain things being broken. And I have to say, my theme yesterday was that I would like to see this newfound power of the Wall Street Bets crowd, of the crowdsourced retail investor, put towards essentially shorting the entire system, our entire financial system, in something that would short circuit all of these people, hurt everyone, instead of just targeting specific funds, which in and of itself is fine, I guess, but it's it's not as grand as it could be. And so I'm encouraged to see more and more posts on Wall Street Bets, which I'm trying to monitor here a bit, about silver. Now, silver is difficult because, this is a market that I understand a little more. The precious metal stuff, because they're commodities, it's something that's real. When you're manipulating it, it's a little more direct and a little more transparent. In the case of gold, silver, and these other commodities, the way that you can manipulate it is by essentially naked short selling, selling futures contracts when you don't actually own the underlying asset. I guess just as a quick explainer, if you don't know what a futures contract is, it is a promise to deliver, some asset in the future at a future date. So, like for example, if you're selling a silver futures contract for March 1st, you have to deliver a certain quantity of silver to the holder of that contract on that date. And the reason, and I guess the basic reason why the prices of precious metals are able to be artificially suppressed is because there are more claims to these metals in circulation in the form of futures contracts than there actually are, ounces of the metals themselves. So let's just say, for the sake of argument, that there's only 100 ounces of silver in the world. Well, in the futures market, there are claims to 10,000 ounces of silver, and so the quantity in the market being traded in the market is artificially being raised. The supply is artificially high, and if you increase the supply, well then all else equal, i.e. demand remaining equal, you're going to get a lower price. And so what does all this mean? How would you create a short squeeze in this kind of a market? Well, it's pretty simple, but it's also very difficult. The simple thing would be to buy up a bunch of silver futures contracts, but instead of just rolling over those contracts to the next period or accepting cash delivery, which you have an option with these contracts, instead of taking delivery of the underlying asset at the end of the contract, you can just decide to take cash, I believe, or you can roll the contract over to the next period. The bottom line is almost nobody ever takes physical delivery of silver, when they buy a silver futures contract. And that's how they're able to sustain this massive supply of silver futures contracts in a market where there's very little underlying physical silver. So by buying up these contracts and taking delivery of the underlying asset, what that forces the banks like JP Morgan, who has been prosecuted for manipulating the silver market before, what it forces them to do is to go out into the market and actually find physical silver to deliver to you. And on top of that, it takes that silver futures contract out of the market, and so the artificial supply of silver is going to shrink. And so it's pretty simple how you would create a short squeeze. You just have to buy up enough contracts to where the sellers of those contracts, the people who are responsible for delivering silver in those contracts, actually have to go back out into the market, buy physical silver, and thus bid it way up because there's way more contracts than there is actual silver. The market is so heavily leveraged that you wouldn't need to buy up every silver contract for everyone to go bankrupt. You would run out of physical silver very quickly if people just started buying up these futures contracts and then taking delivery and then sitting on the silver and not putting it back out in the market, because what you would be doing is you would just be sucking the physical silver supply dry. And so ultimately, very quickly, what you would do is you would get to the point to where the bank or the institution that wrote the futures contract and is responsible for delivering the silver cannot afford to actually go out into the market and purchase the silver for delivery, and they have to default. And once that happens, the whole futures market will collapse, and we will, and the supply of silver will return to the true physical supply. So the key takeaway here would be forcing a deleveraging. Now, there have been some people who have been talking about on Wall Street Bets trying to do it with ETFs, which that's something that I know from past experience and research is probably not going to work because these precious metals ETFs are also going to be leveraged They're also going to operate on fractional reserve, and I would think the vast majority of them are not redeemable on demand, meaning you, as someone who owns the ETF, you just own the ETF, and you can't actually take that ETF with those shares and say, hey, give me my physical silver that I supposedly own. And so therefore, the ETF could, in theory, become disconnected from the overall price of physical silver. It's possible that you SLV, I believe, is the one that they're looking at, and there's other there's similar ETFs in the gold market. You could bid up the price of that ETF and not necessarily impact the physical metals market. And that's the trouble when you get into metals, is that the financial institutions have been working for many, many decades to make it as hard to to increase the price of these metals as possible. And so it's possible that even if the Wall Street Bets guys get on top of this, that they do it in a way that doesn't necessarily actually deleverage or trigger a deleveraging in the silver market, trigger an actual short squeeze. Unless, of course, you're talking about institutions that are short these ETFs, which that would be a much smaller and less important segment. And buying up physical silver is an interesting idea. Going to these sites like JM Bullion, which is pretty great. I think JM Bullion generally has the best prices, though this is not an endorsement of them. I have no sponsors. This is not investment advice. But in that case, the physical silver supply that companies like JM Bullion deal with, the bullion dealers, is not tied to the futures market. And so that doesn't decrease the amount of silver in the COMEX vault in London. And so again, I don't think that wouldn't directly trigger a deleveraging of the futures market, because what you want to target is silver futures. That is what keeps the price of physical silver suppressed. But in lieu of doing that, yes, just buying a physical silver will have an impact, because things will start to look a little screwy if the price of silver coins if there's too much of a physical premium over the futures market. That could potentially cause some problems, because ordinarily the way that these institutions deal with a rise in the price of physical silver, or silver in general, is by issuing more futures contracts, thus increasing the supposed supply of silver on the market, suppressing the price and bringing it back down, even if there's a big spike in demand. But if, let's say, the price of silver coins goes to like $45, but the price of futures contracts is still $27 an ounce, then issuing more futures contracts is probably not going to make a dent in the physical silver price. So this is going to be interesting. It's going to be challenging, but if they can pull it off, this is going to have, in my opinion, a much, much more significant impact, and a much more positive impact than the GameStop thing. The GameStop thing was pretty funny. Okay, sure, you're going to hurt the shorts, who, generally speaking, are not great people, and you exposed Wall Street and Robinhood because they had to do a lot of underhanded, shady, and manipulative things that were probably would be illegal if if the laws were actually enforced fairly, which they're not. That's a story for another day. But righting the wrongs in the silver market would be more than a shot across the bow. I mean, it would be the shot heard around the world, because that is one of the longest running and most notorious examples of market manipulation in modern financial history. So, with that said, if you get anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So, I'll see folks back here tomorrow.